Well, thanks, Gorm. It's a pleasure to join you today to run through the Silvercorp story with you. I think you'll find that Silvercorp's a very unique story in the silver space, and we like to think of it as really a profitable silver producer that's positioned to grow. I'll just draw attention to the fact that in this presentation, I'll be making some forward-looking statements. Now, I'd like to start off with this slide in particular because it really shows a good snapshot of the contributors to our asset value and allows me to speak a little bit to what the strategy is behind each of them. So first and foremost, the easiest thing to assess is we currently have a cash balance of $210 million. That was as of December. We have no debt. Company hasn't done a financing since 2010. We pay a dividend, 2.5 cents US per share per year, paid semi-annually. And you can see from our corporate history, giving shareholder return has been a focus with over 175 million payback to shareholders through dividends and buybacks. But the real strategy here for this cash is to use this as fuel for growth. We're looking at assets that we can acquire, build, and develop into the kind of cash flow machine that we've done with our assets in China. Now, the second asset in this value stack is this investment portfolio. That's the blue bar that you can see here in this cylinder. And as of December, which wasn't really the best time to be valuing mining stocks, that had a value of $122 million. New Pacific, our 28% stake in New Pacific, another public company with assets in Bolivia, is the largest investment. It's actually currently worth $110 million. And just important to note, we've made 3 times our money on that investment when we've invested in it. Now, the strategy with respect to this blue bar is to look at other interesting opportunities to expose our shareholders to growth in good assets. And that takes the form of both investments, more passive, smaller, but also incubation, which is what New Pacific would fall into that category. Now, when we turn to the last bar here at the bottom, basically the base of the company, the red segment, these are the mining assets. And if you take a look at our recent market cap, this has actually gone up. I think we're over 521 million right now. But if you take a look at this this math equation, and you take the market cap and you back out the cash and you back out this value of investments, it looks at what really the market is paying for these mining assets, which is up a bit from this 190 million from when this slide was done, but is still vastly below the analyst consensus NAV of 575 for the company, for the mining assets. Now, these mining assets are really the only engine that's delivered this 4-quarter trailing operating cash flow of just over 90 million. And they have a very low all-in sustaining cost to produce an ounce of silver, both through time and recently. In our December quarter, this cost was $9.28 an ounce of silver production. Now, what we've got underway is a program to optimize these mines, looking at some growth down the road. And so we can see growing from 6.6 million ounces of silver in this current fiscal year, ending in a few days here, to targeting 8 million ounces of silver by fiscal 2026. Now, also important to note that, for these mines, we wouldn't have been able to do what we did if we didn't have a 17-year track record of good ESG and government relations with the various levels of government where we operate in the communities. And we'll touch on that a bit later in this presentation. So where are we? Well, we're located with 2 mining segments in China. So the flagship is the Ying mining district, and that's in Henan province, comprises 7 mines that operate individually and feed into 2 centralized mills. And as well, we have the GC mine in the south of the country in Guangdong province. All of these mines produce the same product, which is a lead concentrate containing the silver and a zinc concentrate. And altogether, our production since we began operations in April of 2006 has been almost 90 million ounces of silver, over 1 billion pounds of lead and zinc. Ying alone has distributed profits to shareholders in excess of 500 million US. And we're in a very healthy situation from a reserve life. We have in excess of a 15-year mine life on a blended basis between our operations. Now, where we operate, we think it has a number of advantages. So we're close to our customers. Now, these are the smelters that many of the mining companies deal with in terms of for treating the concentrates they produce. And so all of our production is sold domestically to smelters, and we get paid the contained value for the metals in those concentrates. We're also close to the suppliers that provide the supplies and services that basically all the mining companies around the world use. So being near to this supply means lower working capital, getting the best pricing for those inputs necessary for mining. We have a capable and disciplined workforce, and really the regulations that have been in place to allow us to mine and operate have been stable since we began production. And we really have quite the freedom in terms of who we sell our product to, and also to distribute profits back to our head office in North America. And I just draw the attention to the fact that, operating in China, we're not alone as far as Western companies. There's many other Western companies that have manufacturing capacity in China. And you can see the statistic, foreign direct investment in China surged to $189 billion, up 10% in 2022 versus 2021. So really, it all comes down to asset quality. And so if you look at that bottom left-hand chart, you can see our most recent all-in sustaining costs that I referred to, $928 US per ounce net of byproducts. But really, over the years, that has been the lowest cost and the most stable performer relative to our silver peer group. And that's what's delivered those high margins. We've got an EBITDA margin of 41% in the most recent quarter, again, higher than and has been more stable than our peer group over the years. Working your way down the income statement, looking at our return on equity, you can see 8.5% the most recent quarter. And again, if you think back to that first slide that I showed you, which showed the cash as well as the investment portfolio, neither of those two elements in the story are contributing to this return on equity calculation. So if you back them out, our return on equity would be more than double what it is right now. Now, the asset quality is what's delivered that consistent financial performance. So you can see on a quarterly basis over the past 8 years, very consistent and stable adjusted net income. And similarly, on a free cash flow basis, we're a strong cash flow producer. And the one element of seasonality that you can see in that chart there is in calendar Q1 is Chinese New Year. So our mines are shut for a 2-week period, which obviously has an impact on the results for that period. Now, just taking a quick look in terms of our metal split, you can see where it's tracked. Most recent quarter, silver was 54% of our net realized revenues. Base metals was 43%, so that's the lead and zinc. And you can see gold was a small contributor at 3%, which we anticipate will grow here as we go forward. Now, looking also from a valuation standpoint, these charts show that relative to our peer group, we're trading at the left end of the spectrum on both an EV to reserves, EV to EBITDA, price to earnings, and price to cash flow. And again, other than the EV correction for cash, none of these figures also factor in that investment portfolio, which is another contributor to value, which doesn't show up in these metrics. So let's drill down a little bit into Ying. So Ying is that the majority producer of our silver and lead and zinc production. You can see Ying comprises 4 mining permits. You can see those red blocks at the bottom of this map. Now, we drilled approximately 1 million meters of core in 3 calendar years. And this aggressive pace of drilling is expected to continue, targeting another 270,000 meters in fiscal 2024, which will begin here in a couple days. And this began looking at some new discoveries of some gold veins, which are right within our resource area. But that program expanded out to looking at our traditional mineralization as well. And it's what's allowed us to, in our last technical report, replace the reserves that we've mined in 2 years, and also identify a number of new targets for reserve and resource growth on the property. We're underway on a mine optimization program. So this is changing our mine planning with this additional drilling results, and also looking at different mining methods, and also bringing in some new technology like an ore sorting machine, which we think can assist with some of the economics and improving the grades of the material that we're actually delivering to the mill. We've started on an expansion program, which right now initially is focused on a new tailings storage facility to ensure the long-term future of the mines, but we'll then move into a mill expansion program where we'll build another mill, a 3,000 ton per day mill at the milling complex, and then decommission our oldest mill that we've been operating with since the beginning. Now, part of this growth strategy includes looking at some consolidation targets in the vicinity. A few years back, we acquired the Kuanping project to the north. It's got some known silver and gold vein structures, as well as some silver, lead, zinc. We've got a mining permit as of late last year, and the current program is to get some ancillary permits associated with the mine safety, the environmental plan, as well as build a mine plan and a mine team, with the objective of developing this mine as a satellite operation and trucking the ore down to the Ying milling facility. Now, a lot of this has been made possible because of this drilling program that I mentioned. You can see the big ramp up that began in 2020 in terms of drilling. But, Ying really has had over 2.2 million meters of drilling since inception. GC, obviously a smaller mine, but also, very healthy drill program there. And this has really been focused on making those new discoveries, increasing our near-term, production forecasts, replacing the reserves, and also really augmenting and optimizing the mine to be able to deliver ore from shallower areas within the mine, areas where we already have development. So talking about production, this chart shows our history in terms of production growth. Very modest beginnings, under 2 million ounces when Ying began, to now where in the last 7 years we've been tracking between 6 and 6.5 million ounces. You can see that coming up in this planned fiscal 2024, bumping that with our midpoint of our guidance, looking at 7.3 million ounces. I'll note that number includes a bit of a gold equivalent converted to silver, as we do anticipate a bit of an uptick in the gold production from Ying in particular. The red box is the GC mine, began production in 2014, a smaller but stable contributor to our silver production profile. Now, we talked about the growth in silver production. Well, this is taking a look at the reserves and resource base. From the beginning, there was actually not reserves, but from all the drilling that's been done, built up a healthy reserve base, which now exceeds 15 years. And, with cumulative production of 90 million ounces, we still have a very healthy future ahead of us in terms of reserves. And I note that those reserves are included in the 210 of M&I, but the resources, the inferred of 150 is on top of that. And we anticipate with that additional drilling, we're going to continue identifying new resources and moving them up into the reserve category. Now, I'll touch briefly on New Pacific Metals, the largest of our investments in the mining investment portfolio. So why invest in New Pacific? Well, the original reason was the Silver Sand project, identified as being a very high potential silver project. That turned out to be true with a discovery and delineation in two resource estimates. The most recent that was announced just late last year of 200 million ounces of silver. In January, the PEA was announced, which speaks to a 14-year open pit milling operation producing 171 million ounces of silver with a very attractive starter pit and first 4 years of production exceeding 15 million ounces of silver per year. After-tax payback is less than 2 years, and you can see the statistics here in terms of the NPV for the project, 726 million and a 39% IRR, very healthy economics. Now, the company has followed this up with 2 additional projects. The least advanced is the Silver Site project, which we won't spend a lot of time on, but Carangas has proven to be a very high potential silver, but also gold deposit with a broad zone of silver mineralization ranging from about 1,000 meters by 800 meters across. And below that, drilling has delivered some spectacular intercepts, 500 to 600 meters of 1 gram to 1.25 grams of gold on top of that. The plan here at Carangas is to finish up this first quarter drilling campaign and go into delivering a resource estimate by mid-year and following up that with a PEA by the end of the year, while continuing to advance the Silver Sand project through permitting. Now, this slide really speaks to the fact that, from a company, we've had a corporate philosophy over the long term of doing the right things. That's, with in terms of environment, safety, the community, our employees, and what we've been really embarking upon in the last couple of years is a program to be better communicators of those programs that we have. Highlights from our last sustainability report, again, a excellent health and safety performance, getting those international certifications. Again, on the environment side, zero material incidents, again, certification. And I'll highlight that all of our mines are green mines, as been determined by a government program in China that looks at every mine on a classification scale of 80 criteria to determine whether or not you're doing things right. From a social standpoint, we've had no issues both internally with our people and externally with the community. We're big investors in the community as well, infrastructure programs. And I'd say last but not least, in terms of that outbound communication effort, the board has formed a sustainability committee as well as a management center for ESG in Beijing, and really looking at aligning our internal programs with the external review and classification that many of the organizations are looking at. On this slide, just looking at our current shareholder base, you can see on the left-hand side our top 10 institutional investors with a mix of some of the ETFs that everyone's familiar with, as well as some traditional long investors in North America as well as in Europe. And from an analyst coverage standpoint, we have 7 firms that are covering us in both spread across Canada and the U.S. Just to sort of recap in terms of catalysts for the company coming up here, we're anticipating increased production in fiscal 2024, doing additional drilling, in particular at Ying, which will add to the reserve and resource base, but also potential to make new discoveries. We're running through those mine optimization programs at Ying and as well at GC to tweak and improve the economics going forward. We expect to have some news later this year on that Kuanping satellite target and bringing that forward into a mining operation. We are building a new mill and tailings storage facility at Ying, which will bring our milling capacity to 5,000 tons per day when it's complete. Didn't really spend a lot of time on BYP, but that's a mine that we have on care and maintenance, which has a gold resource identified and looking to get the permit to bring that back on as a gold operation. And of course, New Pacific, which I just spoke to, has many project catalysts that we expect will add value to our stake there. And as always, we remain on the hunt for new projects, and so looking for potential acquisitions.
Thank you for the presentation, Lon. And in agreement with the stacked cylinder bar that you showcased at the start of the presentation, there are 3 main avenues in which shareholder value can be generated. We will now examine each avenue in turn to better get a grasp on the investment case for Silvercorp. The first avenue being growth of the Chinese mining operations. To frame this segment, it should be understood that the Ying district is the asset, the mining operation of importance to the investment consideration. We can see here that the revenue generated in the Ying district ranges from $200 to $250 million, and this is at silver price assumption of $22 per ounce and a lead price assumption of $0.9 per pound of lead. And we can see here that these are the two most significant metals of importance. You see that we have silver 64% revenue, 28% is from lead. The GC, on the other hand, is only responsible for approximately $30-35 million in revenue contribution, which is why the focus for this segment will be to understand the potential upside of throughput expansion at the Ying district. Now, the Ying district mill expansion is very significant to the Silvercorp investment consideration. It will allow them to double the potential production capacity of the district from 2,500 tons per day to 5,000 tons per day. The main thing that we need to understand is how much of this increased capacity realistically can be utilized, as we can gauge it today. If Silvercorp, for example, are able to complete the Ying mill expansion by the end of 2024 and increase the throughput at the mill from 2,500 tons per day to, say, 3,500 tons per day, according to our financial model, the operating cash flows from the mine will increase by approximately 60%. So the first thing, just about the expansion itself, how much CAPEX remains as of now to complete the mill and the TSF, and more importantly for the mill, when do you actually expect to receive the permit and be able to proceed with the construction?
Yeah, from a CAPEX standpoint, nothing has really changed in terms of our estimates. So it was 30 and 38 million for the two components, so we'll call it 68 million US. Really not a lot has been spent. Most of that's been focused on the tailing storage facility. I think as of the end of the last quarter, I think we've spent 4 million. But in our projections for the upcoming year, the spend is going to pick up, mainly focused on the tailing storage facility here initially. And from a permitting standpoint on the mill, we're not anticipating any issues. It's just been the focus has been from a management time and effort standpoint is on the tailing storage facility. So we think we can get the other permits for the mill later this year.
The issue of the individual mines at Ying have their own throughput permits, which currently would restrict you to actually produce more ore or feed more ore to the new mill. So do you expect this to be a constraint, to actually be able to feed the mill, or will you get them before it's time to, increase throughput? What do you think, Lon?
Well, the rationale for going ahead with the new mill is really based on a few different things. One, as we've talked about, we will decommission mill number one as a result of having the new mill built. And mill number one is the oldest mill, least efficient, also provides the least amount of flexibility. And some of the things that we're seeing in the mineralization, and particularly in these new gold and gold copper zones, the idea is in mill number 3 to have the ability to potentially produce gold concentrates, copper concentrates. So that's one of the reasons for moving ahead with the new mill. We think that we can tweak and sort of tune up the throughput from our 4 existing mining licenses, but that is going to require some additional permitting and permitting amendments, related to getting that throughput limit increased. But we're working on that, and that's one of the projects for this year. And then the other element for increasing the capacity is we do see the opportunity for consolidation in the district. And so Kuanping is but one example. There's a number of other targets, one of which we basically had the rights to as part of an auction, but then due to some sort of bureaucracy in the way that was handled, we stepped back. It could come back for auction again. We might be a winning bidder for that again, as well as some other assets. And so putting this new mill in place is really to accommodate the potential for growth from a number of different fronts, as well as replacing that capacity that is in mill number 1.
when it comes to actually being, done and dusted with the mill construction, when do you expect that to kind of take place, roughly?
Yeah, we based on the change in the schedule, anticipate both the first phase of the tailings facility and the mill would be done by the end of calendar 2024.
You're able to sort of feed 2,500 tons per day now. What do you guys think you can increase? How much more capacity can you get from the existing mines?
Yeah, it's hard to come up with concrete numbers at this point for that, based on the fact that there's some additional permits that are going to be required to increase that throughput capacity. And it's important to note, like, our production capacity is tied to the 4 mining permits that we have, and on some of those permits, we have multiple mines. So what we really need to do to go back to expand that production capacity is, one, identify additional resources in areas, and come up with a mine plan and a mine safety plan that allows you to increase that. So as an example, you can't take a mine that's running at a nice steady state and say, well, okay, look, we've got some additional resources. Let's increase the mine production rate by 50%. That's not necessarily going to be a good idea. You're going to have people bumping into each other. You're going to be sacrificing, some of the safety and other elements that are important. So we need to tie all this in to basically say that there's going to be a new mining operation. We can develop it here, out of the way. It's not going to interfere. And then if we can demonstrate that we can increase the production, we're optimistic we'll get those permits. I'd like to note that up until a few years ago, we had 6 mining units that were running, and the DCG mine is actually on a mining permit that didn't have any mines on it. So DCG is sort of a virgin new mine that was developed in recent years on one of these mining permits. And if you look at the size and also the extent to which we know there's mineralization, we think there's additional mining units that we can develop, but it's going to, as I said, take some time through that multi-step process, demonstrating the resource, demonstrating we can put that mine plan in place.
Yeah, so you also have this permit, which you touched on, for the deeper segment of the existing mines that you're not currently allowed to extract ore from at all. So when do you expect to receive this permit? Do you think there will be any issues?
No, and again, it's a process, and that paperwork for those mines where that's a factor is going to be worked on over the course of this year.
Yeah, it will not be a problem. The mill will be done by end of 24. It will be done before then, you expect.
Correct.
All right, so the second aspect of being able to feed the mill for the Ying district is Kuanping, of course, and that's an example of you growing inorganically, acquiring a new property. So it's about 30 kilometers north of the mill, the planned mill, and can you give everyone a sense of what the existing infrastructure is there? What kind of do you need to do to get this property into production?
Again, what was done to get the mining permit was to identify an initial resource, area that could be developed, and we've got that mining permit. The notional throughput is, and at this point, is targeting a 200,000 ton per year type contribution. So not insignificant. Can't say at this time, whether that's going to be the initial production rate once we get going. But to be able to go ahead with that mining permit, break ground, and start to basically, dig a hole to go underground, we've got to finish up that environmental assessment as well as a mine safety plan. So it's showing the government that we can do this in this fashion without having undue impacts. And then at that point, from an infrastructure standpoint, there's road access kind of right up until the edge of the property, so we don't have to really worry about roads except from the edge of the property to where we'd be mining, setting up a laydown area for mining equipment. So pretty nominal in the way of CAPEX. So I think everything really comes back to the ultimate mining permit, and then also building, while we're doing these other projects, which you've touched on, building a mining team that is going to be focused on the Kuanping operation.
Do you think that you can reach some sort of production from Kuanping before the mill is commissioned, or approximately when it is commissioned?
I would think so. Yeah, I'm optimistic that we'll start to see ore from Kuanping within a year. So that would be ahead of the mill expansion.
And you think that you will store that in a stockpile, since you cannot process the ore? I assume you're close to nameplate capacity currently with your mills.
Yeah, no. I think we'll have the ability to get that ore milled through some tweaks and sort of augmenting some of the practices at the mill. But again, the idea and the reason for building the mill going forward is to have a new, efficient milling facility that has the capacity, to expand and take on a number of the different growth opportunities that we have. And if we, if you use the expression, if we overbuild the mill initially, it's because it just doesn't make any sense to go through the permitting and construction on what is a very economic capital cost of a mill, to undersize the mill, finish it, have these other targets and these other growth opportunities materialize, and then look back and say, oh, it's too bad we didn't build it bigger, because now do we really go through the difficulty of expanding it again? That's just nonsensical. It's better to build something new and have some excess capacity for growth, even if we don't have all of that tonnage spoken for right now.
I mean, to reach sort of a 4,000 tons per day or somewhere up above that, you would need to get more operations into the sphere of influence of Ying. So can you just shed some light? You mentioned that in your presentation, but can you give some sense of how much available potential there are around in the district?
Oh no, there's a number of other projects, and we've seen them, we visited them, we know of a number of other projects that are in a reasonable radius to Ying, and it just comes down to the question of negotiating if it's a private sale or if it's a government auction. Just waiting for them to get all the paperwork together and to put it onto the auction block. And of course, if you look at what's happened in the country, there's been, I'd say, business as usual has gone on pretty well over the last few years, but a lot of new things haven't happened just because of some of the restrictions in the country. So I would expect some of these processes that may have been blocked or stalled do pick up here going forward.
Do these operations usually have their own small-scale mills, or do they ship to somewhere else? How does that look like in the district currently?
It's a mix. There are some older operations in the vicinity. Like Ying is a mining district, and there's other people operating there. I'd say other groups are maybe not operating as sort of well and consistently as we are, with respect to regulations. So, there could be some additional consolidation opportunities there. But then a number of these other targets that we've identified are known deposits, but that haven't actually been developed yet. So there's no mine and no mill. So they would be a brand new deposit to bring into operation as a mine. And what we have as a great advantage is our existing team and milling facility. Down the road, there could be additional milling facilities built at each of these operations. But again, the economics will determine that.
And something that we do see quite a lot is like toll milling agreements to utilize this excess capacity that you guys have. Is that something that you're considering or discussed?
I won't rule that out, but certainly our preference would be to acquire and operate these facilities, these mines ourselves.
Let's move on to GC briefly. It's a smaller mine, but nevertheless, according to our analysis, it's very profitable. It has a great track record of producing, spinning off cash flows each quarter, each year. So and also it has a long mine life, more than 20 years of reserves. So what we're thinking is, are you guys considering, increasing the throughput here, or what's the plan for GC? Because there seems to be potential to improve the economics further.
Yeah, I think the thing that we're looking at in GC, and again, it ties back to a bit of a similar methodology at Ying. GC's obviously got a mining permit with a throughput limitation on it, and so the question is how easily can we get either an amendment or a new permit to expand that production rate? What we're instead looking at is, can we get more metal per ton of ore that we're mining by adding that ore sorting technology. So you see that we've announced the ore sorter that has been in the process of putting in a GC. So what that means is at the mine site, you might mine additional tons, and that's within the permit. But then through the ore sorting, you actually limit the number of tons to within the permitted levels in terms of what you're delivering to the mill, but you're delivering, higher metal content per ton of ore that's going to the mill. I'd say that's the near-term opportunity to improve the economics. Down the road, we can see a situation where, with some of the additional drilling and exploration on what's a sizable property, there may be other areas that we could open up as separate mining units, but for the mine as currently we have it, that's really the immediate opportunity.
BYP, you guys are applying for a gold mining permit, and do you kind of have a sense of when you would be able to receive this permit?
Yeah, it's taken a while, and that's fine. We're patient. Not a lot of value being ascribed to this project. It's looking like, based on all the elements that have been worked on, addressed to deal with broader land use issues in the province, getting the environmental submission. We're optimistic that later this year we would get that permit. And I think we would then use that permit as a catalyst, more likely to monetize the operation.
Are you in talks with someone currently already for that?
I know, but we're majority partner. It's a 70-30 relationship at BYP. So I think the issue is let's get the mining permit, let's get it all ready to go, and then we can determine the next steps in terms of how to realize value from that.
And finally, when do you expect to communicate, more to the markets about BYP? So,
well, I think we're in a process here, and we're waiting. So the next thing really to communicate is when there's a catalyst event. And again, to my other comments, there's been things that I think have taken longer over the years, but also have been impacted, just by the fact that some of these processes take some face time to be in the office, to be in front of people, to be, pushing them and challenging them. And with the restrictions that have been in place, for people to leave our Beijing office to go and to work on these projects and then run the risk of not being able to get back into Beijing. I think that was an impediment to getting some of these things done. But now, obviously, the country's opened up, and I think business may move ahead here at a faster pace. Yeah, to clarify, we're a Canadian company that basically has a majority interest in these Chinese entities that operate the mines. Our track record in terms of production history, and I'd say preferred partner status to be able to operate and get our permits renewed on a timely basis, to get new opportunities, to have been designated as a green mine shows that we're doing some things, some things that are right in the eyes of the government. From a local standpoint, the local government is a huge fan of ours. And so as some of these other projects, become available, they like to see us, and we're invited to participate, in the auction to acquire them. because the view is that we would be a good partner and a good corporate citizen. So I don't really see the issue that many people do, but obviously there's a perception gap there between sort of that expectation or that fear versus the reality. And there's many other Western companies that have their manufacturing bases in China and don't seem to get punished by the equity markets. So,
on your partner at the Ying district, Henan Non-Ferrous Geo and Mineral Resources, can you just shed some light on what they are responsible for in the partnership? Is expertise in operation, or what kind of entity are they in China?
Yeah, they were basically a government agency that was entrusted and that had the rights to these properties, and we entered into a joint venture agreement and contributed the capital to build the mines. And right now, any sort of capital requirements are funded directly by the operations and the entities themselves. And so we, like them, are benefactors for the dividends that get paid out from the retained earnings from those operations. They obviously have a seat and some say, but we're the majority partner there. So, I'd say it's been a very healthy relationship, and they don't necessarily have to put anything in. But if you look at our track record, we also haven't put a lot of money in. These operations have largely been built out of cash flow.
Moving on to the second segment, namely Silvercorp's 28% equity stake in New Pacific Metals. The stake is currently worth more than $100 million US, but I believe that in time, the true value that Silvercorp will be able to unlock through this investment will be a lot greater than the current equity value. What we will focus on in this segment is understanding Silvercorp's strategic thinking around this equity investment. But before this, we will let President of New Pacific Metals, Mr. Andrew Williams, explain New Pacific in greater detail.
Andrew Williams, New Pacific Metals. I'm the president of the company. I joined 2 months ago. Previous to New Pacific Metals, I spent 11 years on the buy side at an institutional precious metals investment firm. Most recently as a precious metals analyst. And I made the jump in industry because of this fantastic opportunity at New Pacific, a company that's discovering and developing world-class silver and gold deposits in Bolivia. And on this introductory slide is a nice photo of our flagship silver sand project. It's the one that brought us to Bolivia in 2017 and has emerged into one of the most significant global primary silver discoveries of this past decade. So why New Pacific? We've got 3 projects, all in Bolivia. The most advanced is the Silver Sand project on the left side of the screen, which is a large silver deposit that can be mined by open pit mining methods and processed using tank leaching. And early in January of this year, we released our preliminary economic assessment, highlighting a 4 million ton per year throughput rate, producing 171 million ounces of payable silver over a 14-year life, yielding an after-tax net present value of $726 million and a 39% IRR. This year, we're heavily engaged in permitting our Silver Sand project and hope to be bringing it one step closer to being ready to finance and build, which will be an exciting and monumental occasion for the company. And Silver Sand is a company-making project in and of itself, but if that wasn't a tough enough act to follow, in the second half of 2021, the company began drilling its second project, Carangas, located in the middle of this slide. And we drilled 150 holes so far at Carangas to the end of 2022 in 64,000 meters. And what we've discovered is a 1,000-meter long by 800-meter wide silver horizon and overlying a broad gold zone beneath that. And that gold zone and the discovery there has really changed the game for us at Carangas. And so This year, our program is to drill 15,000 meters at Carangas with 5 rigs and then complete our inaugural mineral resource estimate by the middle of this year, and then follow that up with a preliminary economic assessment by the end of this year. So Carangas is exciting, it's big, and it's moving fast. And our third project, last but not least, on the right-hand side of this slide is Silver Strike, which we started drilling it last year with a modest scout program, and we discovered a 200-meter thick near-surface oxidized gold zone of 1 gram per ton during that drilling program, and consider Silver Strike to be prospective for both silver sand and Carangas styles of mineralization. So what are we up to this year? Well, at our silver sand project, our goal is to complete a pre-feasibility study by the middle of this year. As I mentioned, we released our preliminary economic assessment at the start of this year. So we're going to tighten up a number of those assumptions, and we're completing ongoing technical work to bring that up to the rigor required of a full pre-feasibility study by the middle of this year. And as I mentioned, we're also working to complete our environmental impact assessment study, which will be a major milestone for the Silver Sand project. And then the ultimate goal is to obtain the environmental impact statement. And then finally, we're working with Comabol, which is the state-owned mining company in Bolivia, to obtain the ratification and approval of an already signed mining production contract that will unlock an additional 55 square kilometers of exploration ground surrounding our silver sand tenements. And then at Carangas, as I mentioned, our goal this year is to complete a 15,000 meter drill program by the end of this quarter, which should be ending this week, to extend the deep gold mineralization to the northeast and continue stepping out on the shallow silver mineralization to the southwest of the area that we've drilled off. And then use that drilling. We'll have roughly 180 holes in roughly 80,000 meters of drilling to complete our inaugural resource estimate by the middle of this year, and then roll that into a preliminary economic assessment by year end. And so this time next year, the Carangas project will be at the same stage that Silver Sand is today. So we're rapidly advancing that project, and that's ultimately how we can create such great value for our shareholders in this business. Time is money. And lastly, at Silver Strike, given how much we've got on our plate at both Silver Sand and Carangas for a company of our size, we've decided to pause exploration activities this year so that we can really focus on delivering on our important objectives at both Silver Sand and Carangas. This by no means underscores the geological potential at Silver Strike. We made the strategic decision as a company that it's in our best interest to really do what we have in front of us right at Silver Sand and Carangas, and look for us to pick Silver Strike up again, back when our internal conditions warrant. So how have we been so successful operating in Bolivia? The first bullet point suggests that we can't take all the credit for it because the geology in this country is unbelievable. Bolivia is home to the 3 billion ounce Cerro Rico silver deposit, which is one that's been continuously operating since 1545. We're also on trend with Peru, Chile, and Argentina, which are 3 countries that host not only some of the world's great deposits, but some of the world's great mines. And we know that Mother Nature doesn't tend to respect man-made borders when depositing metals. A second point that is really important to understand about Bolivia is there's a deep mining culture in the country. Mining's responsible for 30% of the national economy. It's deeply ingrained in the country's DNA, harking back to 500 years, the Cerro Rico deposit, and right up to today, mining is an essential part of the national economy. And in 2021, Bolivia ranked as the 8th largest silver producer globally. And then the third bullet point is probably the one most important for us, is that the country has been greatly underexplored in the last 20 years. When we came into the country in 2017, there were really no other juniors operating in earnest in the country, and today there's half dozen to 10 different juniors that are operating in the country, largely in the wake of the success that we've had at Silver Sand and most recently at Carangas. And when we came in and made the Silver Sand discovery, we're really proud of using that discovery, which helped us to earn a reputation in the country as someone that's a reliable and trustworthy partner. And then we rolled that first mover advantage up and we're able to acquire both Corangus and Silver Strike, and Corangus really being the latest project to bear significant fruit from those relationships and the in-country know-how that we've developed as a company. So zooming into our Silver Sand project, the Silver Sand is nested in a 3 square kilometer administrative mining contract, which grants us the right to mine. As I mentioned, though, we still need to obtain our environmental impact statement, which is something that we're working on in earnest this year. And we've drilled 136,000 meters in Silver Sand, 550 holes in the 5-year span from 2017 to 2022. So we've drilled the heck out of this thing, and that database forms the basis on which we released not only our first resource estimate, but more importantly, that entire data set was used in our updated resource that we released in the fall of last year. And then that updated resource, which I'll show you on a subsequent slide, underpinned our preliminary economic assessment that we released on January 9th of this year. This 5250 cross-section gives you a nice overview of what we're dealing with geologically at Silver Sand. It's a broad disseminated fracture network. We're not chasing half-meter wide, high-grade, narrow nuggety veins as a broad disseminated bulk system that we've drilled extensively. There are areas of this deposit that we've drilled down to 5 by 5 meter spacing in order to really satisfy the most critical of QPs for our resource estimate. And another important point to note from this cross section is that the bulk of this mineralization comes right to surface. The green Tarapaya formation on the top right portion of the slide acts as an impermeable cap that stopped fluid flow from migrating from beneath, and effectively that contact then allowed the silver-bearing mineralized fluids to pool in and around that contact and preserve such a wonderful deposit so close to surface. This next slide gives you a broad overview of our updated resource estimate as compared to our 2019 resource estimate. In bold in the middle of our screen, the 2022 estimate, 201.8 million ounces of silver in measured and indicated, which is an important point to emphasize that, as I mentioned, this preliminary economic assessment was based on the 2022 resource estimate, and over 90% of that PEA was based on measured and indicated, which in the junior mining space, one of the features of a PEA study is that you're allowed to use inferred mineralization, which often can form the bulk of most juniors' PEAs. But in our case, because we'd spent so much time and effort drilling the deposit, we had such a large measured and indicated resource inventory that almost all of our PEA study was based on measured and indicated resources. And the second point to highlight is that the grade. So 116 grams silver, as I mentioned, this is an open pittable deposit, which if we put that into gold equivalent terms, that's roughly 1.5 grams, which would make this one of the nicest open pits to come online for quite some time. And so this next slide gives you a nice overview of the technical parameters that were outlined in this study. So the first bullet point, or the first line item, is the strip ratio, 3.6 to 1, which is including a 18.5 million ton pre-strip. So when we're actually in operations, that number is going to be closer to 3 to 1. And a 4 million ton per annum plant, that's 12,000 tons per day operating over 14 years. So that size of a plant is well within the scope of a company of our size and scale to design, finance, and build internally, which is really important. It's a nice bite-sized, high-grade, high-impact project for us. 107 grams per ton silver, as I mentioned, for open pit head grade. It's just an exceptionally high-grade project for us, and it makes intuitive sense when you go through the strip ratio, the grade, the recoveries, 91%, tank leach marrow crow, why this project delivers such robust economics. And we ran this study at $22.50 silver, which I think is it's in and around where the silver price is today. And the study yielded an after-tax net present value of $726 million US and a 39% after-tax IRR, which is well in excess of any reasonable hurdle rate that one would use to evaluate a construction decision on a project like this. A couple other points to highlight. Mining cost, $9.55 per ton milled. We're going to go with a contractor mining operation, and as part of our pre-feasibility study, we're going to be obtaining specific quotes from potential mining contractors. So look for us to sharpen that number up in the pre-feasibility study. Processing costs, that includes tailings dewatering, and we'll get into our tailings disposal methodology on the next slide, but one thing to note is in Bolivia, the power costs, which is often the bulk of the processing costs in any operation, our power cost is US 5.5 cents per kilowatt hour, and that was a quotation from a local supplier. So another contributor to why our cost structure is so competitive at the operation. And sub $2 a ton G&A, which is a number that benchmarks well against comparable operations in the country, and that all contributes to an operating cash cost of roughly $8.50 an ounce and an all-in sustaining cost of just a little over $10 an ounce silver. So an incredibly cost competitive project at Silver Sand as outlined in our preliminary economic assessment. And the other point that we didn't touch on that last slide, which is a point that I'm particularly proud of as someone that's responsible for going out and coordinating project financing, is that in given the strong production profile in the first 4 years, as we can see on this chart, 16 million ounces per year of silver, the after-tax payback period on this project is under 2 years. And that, to put this silver production profile into perspective, 16 million ounces per year is what silver industry giant Hecla is guiding this year in their silver guidance, from 16 to 17.5 million ounces from their 3 primary silver mines combined. So that these first 4 years are going to be substantial, and that's driven by generally some higher grades that we're fortunate to be able to access in the heart of the deposit early on, and then we get into a bit of a stripping campaign in the middle section of the mine life, and then things pick up again in the back half. But this is exactly the kind of production profile where we can have rapid cash flow and payback in the early years of the mine life that is a really special attribute of the Silver Sand project. So the CAPEX, $308 million initially, life of mine, $327 million. For a company of our size and our market cap, which is in and around $350, $400 million US, this is an entirely financeable project for a company like us. The biggest piece in there is the processing plant, which is that 12,000 tons per day, processing plant, 4 million tons per annum. And then the next biggest component is the pre-strip. So that'll be contractor, 18.5 million tons times our roughly $2 and change. Material movement cost gives us the $47 million pre-strip. Because we're going with a contractor, we're not bearing the upfront capital cost associated with a fleet. So there are significant capital cost savings there by going with a contractor. The next biggest piece in the capital cost estimate is site infrastructure. And if we zoom into that, $47 million, the biggest chunk is we have to bring a power line to site, 20, 30 Ks, nothing extraordinary or significantly complex, but we have to bring it to site nonetheless. And there's also a water reservoir that we need to build to capture excess rainwater for use in our processing plant. There's also some interesting positive social benefits that come from that engineered solution. So that's a really elegant feature of this project, is that there really is, in the grand scheme of things, relatively minimal infrastructure required. Tailings facility is the 4th largest item on that list, $25 million. So we've gone with a dry stack tailings facility, which the the downside is that you bear a significant upfront capital cost, but the upside is that from an ecological perspective, it's by far the most benign solution. It significantly cuts down on the project's water consumption. It also significantly reduces the footprint required from the site itself, because we dewater the tailings before we dispose of them, and so the volume is significantly less. And it also offers a much more robust and stable long-term storage solution from a geotechnical perspective. So it ticks all the boxes, and it made sense for us to go with the dry stack tailings for this site. And then the final piece is that because we spend the capital early and we're disposing this dry cake material in our waste facility, is that we don't have to incur the ongoing tailings dam lifts, which are often a significant component of sustaining capital in any modern open pit mining operation. So I mentioned that we got the power quote from a local supplier. And then there's also elements of the large elements of the processing plant, equipment, and tailings facility that we sourced quotes from global suppliers on. So again, these are numbers that we're continuing to hone on the pre-feasibility study, but nonetheless, we're very pleased with how they came out in this preliminary economic assessment.
Well, I've been an exploration geologist for more than 40 years, primarily focused on silver. And I have been fortunate to work with people and a team that we've been able to make a couple of major discoveries. Juanicipio being chief among them, and that was done for Mag Silver. And a gentleman named Gordon Neal was the corporate VP for Mag Silver. And then he became the president of an earlier version of New Pacific. And he brought me in fairly early to take a look at silver sand initially. I think this is 2017. And so I went and looked at the project, really liked what I saw, and he asked me to become an advisor. And then I was asked by Ri Feng, the founder of the company, last year to join the board, which I did in December. And I should say, my focus is on exploration. And so I look at all of these projects, and the projects and the companies I get involved with have to have big upside potential for me to be interested. You have to put silver sand into context. Silver sand sits in the Bolivian tin silver belt, which contains the second largest silver deposit on the planet, Cerro Rico de Bolivia, which is only 35 kilometers away from silver sand. And there's a belt of big deposits that silver sand is one of, and they are fairly grossly underexplored. They have a lot of upside potential, and silver sand looks like a very large system which is not completely understood. So it's in a great neighborhood. We would call it elephant country. And there's a great example of similar geology very nearby. So the potential for how big it could be is very, very high. I think if you put the pieces of what is known of silver sand together, the geology is telling us that there is much more to that system to be found. So all of that mineralization came from somewhere. There's a source. There's a feeder that brought where the fluids came from and brought them into the areas that have been known so far. I think that the potential for exploration back in the direction of those feeders is very, very high. They're probably lie to depth, which would mean underground mining as opposed to the open pit mining, which is what's envisioned for the resource as known at Silver Sand.
What's the strategy for you to unlock the value of your large equity stake in New Pacific going forward?
Well, I think the strategy here isn't necessarily focused on the immediate value unlocking, because if you think there's more value to be created in that investment. And so what's important here is to focus on the priorities, which is advancing and de-risking the projects and making sure that there's nothing that impedes New Pacific's ability to do that. Going forward, there's a number of different ways over the longer term that we could, monetize these investments, which could involve us acquiring the company or a project or projects, partnering up with another entity. New Pacific could, go the route of Silvercrest and basically bring this great silver asset into production on its own, and we could participate in the re-rate in the equity markets through that. Or if there's another strategic party that puts a higher value on the company or the assets, then we can determine, for our shareholders, we would, we'd be prepared to monetize our investment that way. So I think it's very open-ended, and at this point, it's just important for New Pacific to put its head down and focus on those near-term de-risking milestones.
Silver Sands specifically, is the interesting piece here. It's a pure silver mine, which is that's one thing that's great. We're talking 10 to 15 million ounces of silver per year. So I mean, obviously, it from a size perspective, that would transform Silvercorp if it were to be operated by you guys in the future. And as we heard and saw, actually Silver Sands is rapidly being advanced. So in the not too distant future, it would be ready to be, for a construction decision, essentially. So I'm just trying to understand that how you guys are taking that into your considerations. Obviously, you're looking to acquire something here with your large cash position, which we will get back to soon. But what's the actual strategic thinking here on Silver Sands?
Well, I think as I indicated, it's really focused on what are those elements that are needed to demonstrate value and de-risk the asset. Up until now, we had what would be a healthy market cap for an exploration asset. Now we have a development asset with a first look at economics and some milestones, in terms of de-risking on the community agreements and the permitting. So I think the question comes down to, what is the right timing and what is the right price to do something, and whether that's us, whether that's another party, or whether that's simply the fact that New Pacific can raise money on a reasonable cost of capital to move the project forward and realize those value increases in the share price.
So let's say we have a scenario in 18 months that Silver Sands is completely de-risked, and they turn to they start to actually look for a partner. Would you allow that process to drag on, or will you actually act if it looks like they're having difficulty to actually develop this project? Because you're a large shareholder of New Pacific, and if it just sits there and bleeds money, it will cripple their ability to advance Carangas and Silver Strike as well. So there's synergies to be had there as well for the focus of the story for both companies in a sense.
Yeah, and your one question had a number of kind of questions in it. So we're not going to let it languish, but exactly what we do and how that's structured, for the benefit of Silvercorp shareholders will be determined at the time. And similarly, from a corporate governance standpoint, New Pacific has an obligation to all of its shareholders, not just Silvercorp. So I think, again, it comes back to running things in an appropriate fashion, which is, again, New Pacific doing those de-risking activities, evaluating, investigating all of the alternatives that it can access to get access to capital, make those determinations, and Silvercorp will be making similar determinations on behalf of our shareholders.
In the third and final segment, we will focus on Silvercorp's plan for their large cash position, which equates to roughly a third of their $640 million market cap. Silvercorp has been hunting for advanced stage projects for many years now, And this year is shaping up to be the one where a transaction is finalized. With Silvercorp's track record of consistent cash flow generation and prudent capital allocation in mind, I believe that the upcoming acquisition will be both substantial and accretive to shareholder value. You're looking for a producing or advanced stage development asset, but what kind of, initial capital costs plus acquisition costs are you looking for? What's the size range, that you have set up for yourselves?
Yeah, I wouldn't say there's necessarily hard and fast rules. Obviously, something that's too small, doesn't, move the needle, is a detraction from, management time and attention, doesn't interest us. An acquisition in the, $100 to $300 million range, I think is, well within our grasp, and then a capital cost beyond that. I think the main element here is that if it's a larger deal from an acquisition cost standpoint, how do we fund that? Do we fund that through equity? If it's a big acquisition cost, is it an acquisition or does it become a merger of equals? If after the fact, then there's a large, capital outlay, do we do that on our own or raising the funding through a variety of means, or do we find a way to partner with a group after the fact? I think we've got a pretty open runway here to look at a broad range of things. I'd say there's lots of things that have been presented, which we're looking at, a large initial cash outlay, maybe for even a producing asset, but which was troubled and required a lot of further capital to turn around. And we didn't see, value in those opportunities, but others did. So, so we weren't, active, or we didn't progress, beyond the first stage. But I think there's a pretty broad horizon there. And again, we haven't raised any capital, debt or equity, in a long time. And so for the right deal, I think there's capacity there. And I also think through some of the relationships that we have, which are, I'm not going to say, entirely unique, but maybe sort of where we have better access to some of these groups, we might be able to put together an interesting financing package for what would be a large bill.
Going back to the potential moving forward, I'm being pressing here, I know, but going back to the potential moving forward with Silver Sands, hypothetically, you don't necessarily want to maybe spend all of this cash, so it would be preferable to use some debt and some equity. Am I understanding it correctly?
No, I wouldn't. I'm not too worried about that, because I think, again, it comes back to, if the economics of the opportunity look positive, us in our current form or us in a expanded base will be in a better position to access that kind of funding.
And when it comes to equity, I assume you don't want that would kind of be not the first option, of course, because you are trading to a discount to net asset value.
Agreed at current prices, but if we've demonstrated to the market that we've done good deals and have added good operations to the portfolio, and we get a better valuation assessment by the market, then, like I said, open-minded to a range of financing opportunities to fund that or further growth initiatives.
So getting a sense of the project, you seem very open-minded in terms of financing. The size needs to be significant. But when it comes to the metals, of course, you're Silvercorp, you're a silver mining company. Are you open-minded to kind of hard pivoting towards, a more gold-focused? Obviously, you are, since you bid for Guyana Goldfields. But can you explain the metals, the geology, some of the parameters that you guys are, kind of looking at?
I'd say it's open-minded. You've obviously identified that gold is on the hit list for types of projects. I'd say it's looking at silver or gold with the potential for some byproduct contributions, kind of like what we have currently. And I think it really comes back to the specific nature of the project. So we're doing well with what are arguably difficult assets right now. But we're doing that in a particular environment where it's possible, to do what we're doing. Looking around the world, if we saw an opportunity to build what looks like an economic, quick payback open pit mine in a jurisdiction where you can get a license to operate and get that mine built on a reasonable time frame and generating cash flow, we'll look at that. If we see underground opportunities, I think we're very good in terms of a group to assess that and to deploy the right resources to develop that opportunity. And again, you touched on Guyana. That was looking at something that was open pit transitioning to underground, and we took a long look and saw value in the underground opportunity there. So again, I think it's open-minded, but it's going to have to be the thing that we can acquire and turn to our shareholders and say, we've bought this and we've got a clear timeline and a highly confident timeline in front of us, that we can say this project can be further advanced, financed, built, and brought into production on a reasonable time frame.
So, as we stand currently, are you guys seeing a lot of opportunity out there in the markets, or what's the status like?
I'd say it comes and goes. It's there's a range of opportunities that we see. So some of the opportunities come through specific processes that are run by a party, determines non-core assets, or they have a funding requirement and they look at their portfolio and decide, okay, this is either non-core or is a potential source of funding. A process might be run on that. So, we've seen those kinds of opportunities, and obviously, we haven't, moved ahead. We haven't been the announced, winning bidder on any of those recently, but those continue to be run. We come across our own opportunities just by doing our screening of projects and companies around the world to find these. Some of the things that we had seen in particular towards the end of last year were companies that I would say that were struggling, and we're more looking to our cash balance and hoping that we could be the white knights rescuing by becoming a big shareholder, because the rest of the equity markets weren't there to provide them funding. We've done that in the past, but we're not really that excited and not really interested in doing that right now, because from a strategic standpoint, it doesn't necessarily bring us the ability to move ahead and to build that cash flowing asset. So we've probably pulled back from that and really focusing more on outright acquisitions.
Yeah. So in terms of jurisdictions, is it where is it focused currently? Your more more successful due diligence efforts. Where are you kind of visiting, or?
Well, I'd say it's a healthy mix of Latin America, Africa, and what I'll call sort of broader Australasia.
Okay. All right. And I mean that means that you're completely open-minded in terms of jurisdiction as well. I assume you would not make a large investment in China now. You want to kind of diversify with this next acquisition, I assume.
Yeah, that's the objective. Again, though, from a company management standpoint, if you were presented with just what was a phenomenal economic opportunity, and you turned around and said, "Well, what do we do? Say no to this thing that's going to provide excess returns. And to be honest, I've had meetings with institutional shareholders that tell us that we shouldn't look outside of China because that's our strength, and we should stick to our knitting and just use that to grow the biggest, best China precious metals company that we can. But that's obviously not our strategy. We're looking more broadly. We won't exclude China, but it's certainly not the majority of our efforts at any point, and recently as well.
You're seeing decent amount of good opportunities in the markets currently. Do you have a sense? I mean, obviously you can't say exactly when, but do you think it's likely that something will go through this year?
Yeah, I'm optimistic based on some of the companies and projects that we're currently reviewing that we'll be able to get something tied up and announced here. I've had those feelings before though, and felt optimistic and positive, and then something happens at the last minute, or just for whatever reason the deal doesn't happen, and so it's important to be cautious and not set too high of expectations. But I would say we've identified a few different opportunities here that we're looking at that look like they meet the technical evaluation threshold, and also where we feel that there's room on the other side and a willingness to transact.
Can you just shed some more light on exactly how how your due diligence process looks like? What are these steps that you go through?
Well, for a given target, we have to, at the very outset, think about, well, is this potentially a buildable project? And so, you were talking about open-mindedness in terms of jurisdiction. If you take Africa as a broad example, we could be presented with a project in a country in Africa and sort of rate that and sort of say, okay, no, this country is just not a place where we want to be operating. So even if the geology was fantastic, we wouldn't want to be there. At the other extreme, there's countries where we say, wow, if we found a great project geologically and a willing seller, this would be a great country to be in. And then there's somewhere in the middle where you might say, well, not the best of country, but others have been able to make it work. It's based on the locality. So let's decide whether we're going to evaluate it. Then what we typically do is sign a CA and really start from sort of the grassroots principles, bottoms up, looking at the geology. Let's look at the drill hole database. Does this have the kind of data that supports the resource that the project owner says they have? Or in fact, could it be better if it was looked at a different way? I'd say that's the key element. It all comes down to the quality of the resource. And from then on, obviously, you move through the other aspects of the project, metallurgy, environmental considerations, infrastructure, community, evaluating all of those to see, again, are you identifying fatal flaws that are going to turn your time horizon into 2 times what you thought, or indefinite, in which case everything that you've spent to acquire the project is sunk and lost money, and we want to avoid that at all costs.
What do you think that Silvercorp will look like in 5 years from now, in terms of size, market cap, production, cash flows? Go whichever direction you would like, but.
Yeah, well, I think they're all tied together. I think we will be a multi-mine, multi-jurisdictional company. We might not be called Silvercorp at that point in time, based on what the asset mix is. I think if we've been successful, we will have taken our roughly 50 million of free cash flow and multiplied that by 4 to 5 times. With maybe 3 to 4 producing assets, maybe more if we're particularly lucky. But I think it'll be a very different company with as I said, diversified production base and diversified geography, giving investors sort of a best of breed precious metals investment vehicle.
Excellent. All right, Lon, that was a great talk with you. So thank you for that.
Well, it's great. Thanks, Gorm. Always a pleasure to chat. I enjoy your questions, and I look forward to providing you with additional details on some of these these key points as we've got concrete information that we can release to the market.